everyone, and welcome to another episode of Five Questions with from List Self Storage, where we sit down with industry leaders um, to get quick insights into the self storage market. Today, I'm joined by Peter Smyth, CEO of White Label Storage, a company leading the way in third party management solutions. We'll be diving into some of the most frequently asked questions around revenue management and pricing strategies. But first, Peter, can you tell us a bit more about what White Label Storage is doing in the industry and what sets you guys apart?
Sure. But first, thanks for having us. We are White Label Storage is a full service third party manager. We have our own customer service team. We build our own websites that integrate with the storable website or software products. We do revenue management and we manage what's happening at the facilities. We also do a little bit of a la carte stuff. We do some call center only services, some website only services, but our bread and butter is full service management. We've got now over 175 storage facilities on our platform, and we're continuing to add facilities around the country. So we're happy to be here, able to share whatever wisdom we've gathered over our years of management.
Thanks. That's a great overview. So let's jump into our five questions, starting with something we hear a lot from owners and operators, which is what is the biggest mistake owners and operators make when it comes to revenue management?
I think the biggest mistake is not something that people do necessarily, but something that they think. It's that the believing that the street rate or the listed price of your vacant units is way more important than it is. When it comes to revenue management, there are so many other ways to impact your top line that have nothing to do with what you're listing your units for on your website. One of them is selling insurance. Part of it is moving rates on occupied units. It's selling other products or investing in technology that you can then upsell to clients because creates a better experience or a better product. So whatever you initially sell or rent that unit for is just going to have very, very little impact on the long-term lifetime value of the tenant because their rate is going to move. The products that they buy from you are going to change, and in many cases they move out and somebody comes in at a different rate. So it's important for sure to figure out where to price your units, but it may not even be kind of like where you would start. I mean, with selling insurance alone, you could roll out a 10% revenue increase within the first 60 days. So I think that's something that people seem to really focus on when it's actually not the biggest piece of the pie there.
Why do you think people are so focused on the street rates rather than everything else they can be doing?
I think probably because it's the easiest part. There are the most products out there trying to serve that or solve that problem. Like pricing a unit is productizable, whereas sort of holistic strategy is it's more of a service than a product. There's StoreTrack and Veritech and ProRise and Yardi and then all the stuff that's built into the FMS providers out there, and it's easy to sell something like that. I mean, because it's easier to build than it is piecing everything together. So I think that's why people come in and a lot of times when we're talking to clients, that's the thing that they ask about, or when we're managing for them, it's the thing that they're focused on when maybe they shouldn't be.
All right. Now let's talk about one of the most sensitive areas tied to revenue and raising rates. How can you raise rates without losing tenants?
Yeah, definitely need to be thoughtful about this. And there are ethical concerns across every industry when it comes to raising rates, and there are problems right now in our own industry related to that because it is an industry that, like, the structure and legality of raising a rate can allow for you to maybe try to gouge a customer. But I mean, it's just there are certain things you should probably avoid. One, if you are in the middle of a season where street rates are down and where rates at competitors are lower than where your in-place tenants are, and you go to move rates on those tenants, they're just going to look, they will look at even your own rates on your website and rates at competitors and say, hey, you're moving my rate and I'm already paying more than what you're selling this product for. So I think timing is a piece of it. I wouldn't, in the dead of winter, if you're in a seasonal market, not usually, that tends to be kind of a low demand part of the year, and that's not a great time to be pushing rates unless you're really actually full and trying to create some vacancy. I I think a strategy with your team around being willing to negotiate is something that can really move the needle. I mean, if you just send out a notice and just let things be, you're going to get more churn than if they call and you're willing to either, negotiate a rate in between where you're moving a tenant to, or even meeting them where they are. Like if you can move 20% of your tenants and 5% of them call you and are threatening to leave, you probably there may be a scenario, depending on what your occupancy is, where you just want them to stay at their current rate. And that's fine too. So, and then maybe a third piece is, if it hasn't been done, if you've recently bought a facility, or even if you haven't done it in a while at your own facility, like I think doing it in tranches is smarter than doing it, all at once, because, you will experience some churn and you don't want so much inventory sitting on the market at one time. I mean, that's, structural vacancy is a part of the game, and you'll always have some empty units, but you don't want to have too many at once. That's bad revenue management.
Right, right. Communication and timing, that's key.
Yeah.
All right, on to our third question. Are there other ways to increase revenue without charging more for rentals?
Yeah, we talked a little bit about this in the beginning as it relates to the rates themselves. But if you remove ECRI and the street rates, you've got insurance you can sell. You can sell locks. You can charge admin fees on move-in. Again, these things will impact your ability to convert a customer. Like a $35, we have seen kind of across the board, if you start pushing your admin fees more than $35, you're going to start to turn some tenants away in a meaningful way. And then there are other investments you can make that you can turn into recurring revenue. Storage Defender is the one that comes to mind right now. It's a sensor that you can put in a unit. You can sell it to a tenant so that they know they'll get a notification if somebody opens their unit. It's a security feature, and it's something that people will pay for. Similarly, you could have a portion of your facility have automated locks, like a Noki system or a Kiss smart lock. And that is an opportunity to create another recurring revenue piece. We try to focus on the things that are recurring in nature more than the one-offs. It's hard to sell when you go to sell your facility, or you think about the value. These kind of like selling locks and selling, and admin fees tend to not be a big piece of the underwriting there. So it's really, what can you do that is a durable, recurring piece of your income stream? So I'm thinking insurance. I'm thinking, technology, things along those lines.
Right. So I guess that brings me to my next question. How do you measure success with these non-rental revenue streams? So you mentioned you want to kind of focus more on something that's more recurring rather than the one-offs.
Yeah, I mean, there are certain KPIs that matter, right? Like the biggest one would be like the attachment rate or the conversion rate. If you're selling anything, whether it's insurance or smart locks, you're thinking about attachment rate the same way you'd be thinking about occupancy at your own facility. If you are selling insurance and only 10% of the customers buy it, you're doing something wrong in the sales cycle. If it's worth selling, then you should be focused on having a high conversion or attachment rate. So, if you could invest $50 in every unit and get another $10 per month, that's a 20% return on that investment in month one. You should be focused on that, and you should be advertising it on your website. You should be encouraging your sales team to be educated on it and be able to sell it. Those are things you should be tracking, and that is something that we as a manager report on, right? Like we report on the attachment rate for insurance products.
Great, great. Now let's dig into something a lot of owners are curious about. How do you know if you're pricing units correctly for your market?
Yeah, this one, um, you know, the obvious answer is looking at if you have real competition. So I think within depending on your market, depending on if it's so rural, like the classic radius you should care about would be like something around 2 to 3 miles is where your true comps are. Because again, you're thinking about your own rates as it relates to where someone else who's looking at your store might look. If you're in a very rural market, and that might be you might have even go to like a 10-mile radius. But most people will look at competitor rates and peg their own rates based on where some combination of where their competitors are. And that is important, but it can lead, if you're purely driven by that, you don't know all the factors of those facilities, and it could quickly turn into maybe a price war, where you lower your rate, they lower their rate. So I think the most important thing or indicator would be your own leasing velocity. If you are renting units at a rate, you've determined that you have achieved some proxy for the market clearing rate, and maybe you want to test pushing it. If you're leasing at a high velocity, you probably want to push your rate a little bit. I mean, like that is where I would start. If you're not leasing any units, first thing I would do is before lowering my rate, make sure that my website and software works, make sure that I'm advertising correctly and I'm searchable online. But if you check all those boxes and you aren't leasing units, like it could be a pricing problem. So at the end of the day, your own sales are the best indicator of where prices are in the market, because you also it might tell you something about your facility too. At the end of the day, if you've got a facility down the street from you at a certain rate, you go over there and it looks like they're full and you can't rent units, they might just have a nicer facility, and maybe you need to think about capital expenditure and ways to level up your facility experience.
Right, right, right. And once you've got your pricing dialed in, it's also important to think about your mix of units. So,
Yeah,
what unit types or sizes generate the highest return per square foot in your experience or from what you've seen?
definitely the smallest ones, but that doesn't mean you should create a unit mix full of 5x5s. Like there is this, it's the same thing in the apartment world where, a studio will rent at a higher per square foot usually than a 3-bed or a 2-bed, because the absolute dollar amount, there's a bit of an arbitrage there where the absolute dollar amount is lower, but the per square foot is higher. If you fill up a facility full of 5x5s, you're never going to rent all those units. And so you do need to do some feasibility around what is selling in the market. You should talk to an architect about how to be most efficient with your footprint. It just, bigger units also allow you to cover square footage more efficiently and create a floor plate that is a higher ratio of rentable square footage than egress and aisles. So it's not just about the price per foot per unit that you should be thinking about with your unit mix. It's about the correct mix of inventory that will sell, what the demand in the market is, and how to be most efficient with your asset when thinking about the gross square footage and the net rentable square footage. We're very familiar with that at White Label, because we have this business Local Locker where we do these retail installations in cities. And in New York, you can rent a 4x4 unit for $150 a month, which is crazy. And anybody who listens in here would be shocked, but it's the case. That doesn't mean that your neighborhood will rent 1,000 4x4s. And when you make everything a 4x4, very quickly, 2 4x4s back to back, that's only 8 feet. Then you're onto your next hallway, right? And that's non-rentable square footage. So you expand it a little bit, and more of the space is rentable. So we are always thinking about unit mixes when it comes to efficiency and inventory mix.
Right. You also have to do your due diligence and see what is selling
Exactly.
in the
Yeah, the
market. Yeah,
feasibility for sure.
exactly. Well, that brings us to the conclusion of our segment. So, thank you so much for joining us, and we'll put down on the screen how our viewers can connect with you and your team. So, is there anything else you want to tell our viewers? Anything exciting? Any upcoming new enhancements or news for white label storage?
Sure. We have done our own sort of revenue management tutorials, and we have a knowledge base we're trying to build out, and that will ultimately conclude with our own pricing and revenue management tool that we've spent the better part of the last quarter at least building. We rely on some other vendors right now to do some of our pricing, and we do a little bit of it manually. And we think that a piece of it always should be manual. You always should have logical parameters. You should have somebody signing off on rates, but and comps. But we're excited to announce this, and we will very soon.
Great, excellent. That is excellent. Well, thanks everyone for watching, and we'll stay tuned for the next episode of Five Questions With. Thank you so much, Peter. Have a great day.
Thanks for having me.